What's up, YouTube? So part of my daily routine is going on r/options or r/Wall Street bets and seeing the absolute degeneracy of people twice my age gambling away their $500,000 house, or kids doing the most insane YOLO bets and they lose their parents' life savings, and now the wife or the mom is now doing OnlyFans just to make ends meet. It's a disaster for all, right? And it's pretty appalling how people still don't know how to trade options in a safe way. And I'm going to teach everyone watching something called credit spreads. And now, credit spreads, in my opinion, are some of the most safest ways to trade options. And it's profitable. Now, I won't promise you won't get burned. Everyone gets burned. So, without further ado. All right, so first things first, we will be going over which brokers to use. And me personally, I use Robinhood. I love the GUI and hasn't screwed me over yet. I know it's controversial for a lot of people, but I'll die on that hill. And I love Robinhood. And no, I wasn't paid to say that. So we will actually be hovering over your referral link. So I'll be posting this below anyways, but if anyone doesn't have Robinhood yet and wants to, they could just copy in my link and we will both get free stocks, which is amazing. So with that being said, we will go over to SPY. Before we get into actually doing it, let me explain to you what a put credit spread is. So when you're selling a put or writing it, writing is synonymous with selling. So just keep that in mind for options in general, right? So you sell a put option, which means you're selling someone the right to sell you a stock at a certain price, aka the strike price. For selling this option, you receive a premium, which is the money up front. That is what you want. That is what you need to keep intact, right? And when you buy a put, that is pretty much what you're using as leverage. So at the same time, you are buying another put option on the same stock, but with a lower strike price than what you wrote the option for. This costs you money. Yes, it does. So it makes your profit smaller, but it limits your losses, especially if the stock falls down dramatically, right? That still keeps you safe. So that's very important to keep in mind. And the idea is to make money from the premium, right? Which is received for selling the put option, which is more than what you would pay for buying the lower strike put option, hence the term credit spread. You ideally want the stock to stay above the strike price of the put you sold, so both options expire worthless, which you want the other guy at the other end. You want his money, his options to expire completely worthless, which is likely because with SPY, it doesn't move that much. It really doesn't. It's not a stock that's going to be as volatile as like Apple or, Amazon or, crazy meme coins. Just think about it as you are making money off someone that has no idea what they're doing, right? Because if you're an investor, let's take this as an example. If you're someone that is trading options and you're going to buy a put on SPY, right, with no other leverage, you're just going to buy a put and you think that it's going to be a bloodbath of a week or a bloodbath of a month. And you think that it's going to go from 520 to, I don't know, 505. Maybe you should lose your money because that's ridiculous. That doesn't happen. Well, you know what? Let me stop right there because sometimes it does happen, especially, if there's a financial crisis, COVID, black swan events, etc., but it's not common.
I am never going to financially recover from this.
But normally that doesn't happen. So keep it in mind like this. Imagine, here's another goofy analogy. Imagine you are someone in the gold rush and you know that the gold is gone. It is absolutely gone. You are selling tools to a bunch of random people that still think that there are gold in the mines, but you know that they're empty. So that's essentially what selling puts are for the stock market. And of course, you're buying a put as well. The leverage is important. You need to write that put and you need to buy another one below that. All right, now let's get around to actually calculating our credit spread. So for this example, we have underlined stock symbol, SPY, get price, and it is accurate. It is at 523.07. Now for our short option, we're going to write it. And I scheduled it out for 12th of April. Where are you? At 5:15. Nice. I'm going to buy a put just right under that for 514. And notice how to sell it, I would get a premium of 151, right? And then right over here, to buy it, it would cost me 135. The difference of that is 16. Okay. So I'm going to calculate. Nice. And 16, right? Because it is 0.16 per share, and every contract has 100 shares. Keep that in mind. So let's see here. Now, what happens if time goes on and you end up in the money? I mean, so deep in the money that we had a terrible week. Well, your max loss is $84. Your maximum risk. But your entry credit is 16. Okay, this is nice, right? Because as days go by, something works in your favor named theta, which is the Greek. Now, I could make a whole separate video about the Greeks because it is very lengthy, but they are very important. So notice again, as days go by, you go from $3, then 7, 8, 10, 12, 16, boom. You get that whole credit back. Now, again, just keep in mind, your maximum risk, $84. Now, you might be thinking to yourself, why in the world would I do all of this for $16? And I think that is a fantastic question because me personally, I would not. So you would do something else right here for this long option. Instead of buying right under it, you would go a little bit wider. So from 514, let's say you want to buy a way cheaper put, right? Let's buy it for, 0.90, right? 0.61, okay? So that's the spread price. That means your maximum gain is $61. However, your maximum risk is $439. Okay, so do what you can handle. I think that, especially if you know the technical analysis, if you know what you're getting into, if you understand the market, by all means, go ahead. This isn't financial advice, right? But there is another way too. So let's say you don't want to make it that wide. Well, okay, sure. Let's do it this way. I'm going to go ahead and write an option, and I'm going to project it. Today is the 30th of March. I'm going to project it for, 31st of July. Which, by the way, that's very ballsy. You don't know what's going to happen between now and a couple of months. Okay. So I'm going to go ahead and do it for, 515. And then I'm going to write it 31st of July. Remember, this works when they have the same date. 31st of July, I wrote it for 515, and I'm going to buy it for, maybe 505. Okay, that's $2.42 per share. Okay, so that means my max gain is $242, and your maximum risk is $758. Now, those odds seemed way better than the scenario that I plugged in earlier. The problem with this, though, is that since it's such a far out projection, you don't know what's going to happen between here and now. But on the bright side of it, you do get more money. To finish this off, I will simply do a little demonstration on Robinhood, I guess, yeah, Robinhood. So let's go ahead and sell a put. You know what? Let's do it for April 9th. No, you know what? Longer. April 19th. April 19th is good. So I think that you are crazy if you think that SPY will go under 517 by April 19th. And let me buy my collateral. Boom. Cool. So for 262, 242, I come out with $20. Oh, sorry, 23 to be specific. So that's my expected profit and loss. Okay, cool. But my max loss is only $77. Not that wild. And then my break even would be 516.77. So that means that by April 19th, if SPY is at the price of $516.77, that means that I break even. So, boom, type it in, review order, and I would pretty much submit it. All right, guys. So if anyone has any more questions, feel free to ask. I am normally always available, and I will be pushing out videos a lot more often. So have a fantastic day, and you guys stay safe.